Okay, I'm going to go ahead and call the meeting to order. I appreciate everybody being here.
Doug's on the phone, so
Doug,
we're good.
fantastic. All right. Well,
Good morning, everyone.
Good morning. We have an agenda before us, so we need to go. Well, let's start with roll call. John Fisher, member.
David Rader, member.
Pat Keough, member.
Harvey Lewis, member.
Matt Barker, member.
Mary Gregory with Brown Advisory.
Greg Williams, staff.
Brendan Fabrica and co-consultant.
And on the phone.
On the phone?
Good morning, this is Cynthia Curry.
Great, fantastic. All right. So we have an agenda before us. I entertain a motion to adopt the agenda as presented.
So moved.
Do I have a second? All in favor, please say aye.
Aye.
We have the agenda adopted. So we have the minutes from our June 23rd meeting. Again, I think everyone's reviewed those. If there's no amendments or adjustments, I'd entertain a motion to accept the minutes.
So moved.
Got a first and a second. All in favor?
Aye.
Aye. All right, the minutes have been approved. All right. The next item on our agenda is presentation by Twin Capital. So, gentlemen, you have the floor.
Thank you very much, and good morning, everybody. Sam Gerber from Twin Capital here. I'm the Director of Business Development, and joining me today is Jeff Gerber, Twin's President, CIO, and Portfolio Manager on the Twin Prime strategy. Would just like to say, good morning to everybody, to the trustees, to staff, and to Brendan. We appreciate you having us in here today to give you an update, and especially appreciate the opportunity to participate virtually as if we weren't able to make it down to beautiful Gainesville this morning. So, in terms of an agenda of our presentation, I will give a very brief update on the firm, a couple of points, updates since our time last year. Then I'll hand it over to Jeff, who will talk about review performance, review the portfolio and how it's positioned, as well as discuss a brief outlook for the markets and our thoughts on some themes that we see in the equity markets. So if we turn to page 2, I'm not sure who's controlling the slides. I'd be happy to take it over on Zoom, or if not, we can call it over. But if we're looking at page 2, as you can see, we ended July with about $1 billion in assets under advisement. That's made up of about $870 million in assets under management. As you can see, Prime is our largest strategy with over $500 million in assets under management. In addition to those assets under management, where essentially we're trading the account and have discretion, we have over $100 million in assets under advisement in the Prime strategy. So essentially just the difference is that unlike, again, for your account where we're doing the trading and have discretion over the account, it's a model delivery for us where essentially we just send the portfolio to a wealth management client. So all in, over $600 million in assets in the Prime strategy. A couple of notes just on flows. We have gained a couple of Prime accounts so far this year. We have a relationship with UBS where the strategy is available on that platform, and it was promoted earlier this year, by the manager research, and now we've gained a couple of additional accounts so far in the Prime strategy, some new accounts. And additionally, overall for the firm, we've had some growth this year through a couple of relationships with some additional RIAs and a family office for our tax managed strategies. So for our enhanced 50 for other strategies of the firm. So all in, despite the market's overall decline this year, to see some new assets coming in has been nice on that front. One of the real, don't really have too much in terms of changes or updates in terms of the firm. The one very quick thing I will note, Brendan's colleagues at ANCO are aware of this. We had our annual, not annual, but we had our SEC exam conducted within the past year. We received a zero deficiency letter, which was quite an undertaking to go through their routine exam and audit. The one we were quite pleased to pass with. Essentially, flying colors and receive a zero deficiency letter. Incidentally, it's the second one that we've received from the SEC. The last exam was in 2015. So, being a boutique manager, we take transparency and compliance and all those things obviously quite seriously. And so we were pleased to receive that from the SEC. Unless there's any other questions, I'll be quick and pass it over to Jeff to talk about the portfolio.
Great, thank you.
And I'll say good morning, everyone. Good morning to the
to the board and staff and Brendan and Mary from Brown Advisory. Just one point on here, what we're managing for you are prime strategies and enhanced index strategy. And as the fourth bullet on the left side shows you that of that current page, Twin is the 10th largest enhanced index manager, even though, as Sam points out, we manage roughly $1 billion of assets under management and advisement, but yet we're still the 10th largest enhanced index manager. What an enhanced index strategy, maybe if you could go, William or whoever's controlling this, maybe if you could look at page 4, just for a second, just to kind of remind you of how we do the strategy. The strategy itself is we basically, it's a quantitative strategy or bottom-up strategy with a top-down fundamental tilt overlay. So the goal of our strategy is to build a portfolio that looks, that feels, that smells like the market, the benchmark, the Russell 1000, but at the same time is looking to outperform consistently without taking a lot of risk. The city of Gainesville's portfolio is highly equity oriented. It's growth oriented from an equity perspective. This piece of your portfolio, our goal is to outperform the Russell 1000 consistently over time. And when we lose, we keep it close. So we understand the mathematics of investing. You know, when you lose 20, you need 25 to get it back. You lose 50, you need 100 to get it back. The more you lose, the more you need to get back. So basically, our approach is really one of focusing the portfolio on buying the right stocks. So on this page, what are the right stocks? We're looking for stocks that are cheaper than their peers, stocks that have rising earnings expectations, earnings growth, have positive earnings surprise, improving quality metrics, and even positive price trending, meaning it has good relative strength, while simultaneously we're looking to sell stocks with just the opposite. We're looking to sell stocks that are expensive, that have negative earnings growth expected, or negative earnings surprise, or deteriorating quality metrics, or negative or falling relative strength. So that's what we're looking to buy and sell. But what we do is we have a model that ranks stocks, but we also think about the portfolio from the top down or from the fundamental tilt. How much risk do we want to be taking in your portfolio? Is it a good or bad environment for active management? So we study a lot about the market environment and the appetite for risk, and those are the kinds of things we're looking at thinking about, and thank you for moving back to this page, from the bottom up, kind of, as well as the bottom up from the model, and the top down being more on the fundamental tilt and the managing of risk. And by capturing market trends, we know that our portfolio is going to look like the market. So whatever the sector weights are, it's roughly going to be the sector weights of your portfolio. The market is roughly 50% value, 50% growth. We're going to be roughly 50% value and growth, but maybe we want to be a little more value at times, and maybe we want to be a little more growth at times. So those are the tilts we're going to apply in your portfolio. So if we could perhaps now move to putting it all together on page 6, if that were possible. Page 6 in your materials, thank you, kind of puts it together. So we're looking for stocks. Again, we're looking ideally for stocks that are cheaper than their peers, with rising earnings growth and good quality, where those elements create a model that gives us a predicted return or forecast or alpha for every stock. We rank stocks from best to worst. But then when we build our portfolio, we very much want to think about, from a top-down perspective, how do we want the portfolio at the margin to be tilted relative to the benchmark? And so that's kind of the process in an kind of a flow chart perspective. Your portfolio, the prime portfolio on page 7, is again an enhanced index strategy. It has a beta right around the market. This is, while we are a quantitative strategy with a fundamental tilt, we are not a high-frequency trader. We're not turning the portfolio over. In fact, you can see here on the page, the average turnover for the last 5 years has been just over 25% a year. The average holding is roughly 4 years for every stock. So we're not turning over the portfolio. We're just at the margin trying to tilt the portfolio to the right segments, styles of the market. We want to be on the right side of risk. If we think risk is going to go up, we'd rather take less risk. If we think, risk will be controllable and the model and the environment will be favorable for active management, then we'd rather put our pedal to the metal a little bit and take a little more active risk. So dynamically managing risk is really important for us. And with that said, that's an overview of the process. Let's get into your numbers and your results. So on page 8,
Actually, Jeff, before I have a couple of questions, if you don't mind, just a couple of things before we go on, so I don't lose my thought. You mind if I ask a couple of questions?
please,
Okay.
John, as you know, we love questions,
Great.
so please.
So obviously, some of the metrics you're looking at to build your forecast, some of them are trailing, right? You have the current data, you can see what's going on, and you can plot it, and then some is really forecasting and trying to anticipate what's going to happen. So I'm curious, one, where are you gathering that information, and how much of that is in-house evaluation that you're cooking up, and how much are you buying off the street? So if you just kind of explain where you're getting your research, and there's a lot of data points that you're tracking there.
Absolutely. So you're correct. We have multiple sources of data, John. So the sources of data would be FactSet, Bloomberg. We're basically getting, you're absolutely right, some of it is reported data from company, from company filings, from earnings reports, and some of it is expected. The expected data is consensus. We always focus on consensus data. We are not coming up with our own direct forecasts, but we are using consensus. Our hypothesis is that the market reacts to change in expectations, and the best way for us to measure those change in expectations is to look at all earnings forecasts from a consensus basis. So that data will come from IBES, or now Refinitiv, as Refinitiv owns it, as you know, John. Many companies have bought other companies and acquired smaller data vendors, but we are basically pulling the data from FactSet and Bloomberg, and we're pulling it from multiple sources, whether those sources are S&P CompuStat, or IBES Refinitiv, or Thomson Reuters. So we're pulling the data from multiple sources.
Okay. Great. All right. And then the other question on, I think it was slide 7, you talked about your relative turnover. I'm just curious, for a straight index, what's a typical turnover in the indexes relative to yours? So I know you're being more active, but I'm just kind of curious the comparison in general.
Oh, absolutely, John, that's a great question. So the Russell 1000, as you know, has an annual reconstitution. There could be some corporate actions during the year that change it. The average turnover for that index is probably in the 5 to 10% range.
Gotcha. Okay.
Per year.
Thank you.
It depends on what kind of corporate actions. I mean, if you get a big merger among two big companies that represent 2% of the market, it's going to be it's going to be closer to 10, but typically about 8% a year.
Okay. And then my final question is, obviously you're tracking a lot of different risk metrics. How do you track and adjust for valuation risk? I mean, I don't think that's one risk can be just diversified away. If you got overpaid too much for something, that's a challenge. So I'm just kind of curious, on your risk metrics, how do you evaluate and kind of make adjustments for what you would perceive as a valuation risk?
Right. So if there are, when on the value side of our model, we look at both earnings, forecasted earnings relative to price, and we look at book value relative to price. So we are looking, and we also look at value in terms of, one of the other elements is how much total debt does a company have relative to leverage. So we're looking at value, and that's a great question, John. When we're looking at value, we're looking at value always on a relative basis. So what we care about is we know we're not looking to build a portfolio of just purely low PE stocks, because that would be a portfolio of utilities and all staples. We're looking to buy the most undervalued companies within each sector or industry group. So we are focusing on relative value, not absolute value. And that's an important point, so I thank you for bringing it up. We're not looking at absolute value, and on the growth side, it's also similar. We're not looking for absolute growth. We're looking for relative growth. We're looking for the companies that we believe are going to grow faster than their peers. And we understand that growth rates of tech companies are very different than growth rates of utilities. So we want to compare everything we look at is, in a sense, sector or industry group demeaned or relative.
Right. Thank you.
John?
I hope that answers your question, John. Great question, so thank you.
Go ahead.
Oh,
Are you always fully invested or try to be fully invested, or do you ever make a strategic call and go to cash?
no, we do not go to cash. We are always fully invested. Our goal is to outperform the index over time, and we're not going to be doing that if we hold cash. Let's just put it in numbers. What is the historical return for the Russell 1000? Call it 10%, call it 9%, whatever it's some number around 10. So if we hold 10% cash, we're going to give you a return of 9% annualized, assuming we gave you, in fact, the exact market index. So we are always fully invested with the goal of trying to outperform the market. So thank you for that question. I hope that answers it for you.
Great, thank you. Okay, please go ahead. Please continue. I appreciate that, Jeff.
Oh no, absolutely. So let's talk about your returns on page 8. Let's talk about it both from a dollar perspective and a return perspective. So in terms of our relationship, we were very fortunate to start managing money for the city of Gainesville in May of 18, just a little over 4 years ago. We were awarded with a $33 million mandate. Over the next 3 years, a little over $5 million were taken out for expenses, benefit payments, rebalancings, etc. In 2020, early in 2020, you gave us $5 million. And then, as you know, you did the pension obligation bond in 2020, the end of 2020 and early 2021, and then over those 3 months, you invested an additional $20 million. So net asset flows in are just under $53 million, $52.98 million. As you can see, the value at the end of July was roughly $67.65 million. So over this 50-month period, your account has grown by almost $15 million, by $14.7 million. The annualized return of your portfolio and the annualized risk, you can see in the bottom, you have slightly underperformed since inception. It's really been a tale of 2 halves. This 50-month period, we underperformed in the first half, but we've outperformed in the second half. And in fact, from a timing perspective, if you go to page 9, you can see on page 9 that the timing of your pension obligation bond was a really good timing, not only from a market perspective, but also from a value-added perspective or relative. So both on an absolute and relative basis. So to remind you, you awarded Twin 3 tranches, 5, 7, and 8, total of $20 million. Since then, from November of 2020 through July of 2022, over that 21-month period, you can see that your portfolio has gained cumulatively almost 30%, both gross and net of fees. Remember that we do provide a special fee to the city of Gainesville that's strictly performance related. So you've produced a 30% return, 29.8% return, when the cumulative market is, you can see, 27.3%. Just to give you some more current numbers, year to date, you can see you're outperforming by 1%. For what it's worth, for the year ending July, you're outperforming by 1.9% relative to the market. So there's been very, very strong performance. I remember when you were evaluating, you had all managers talk to you back in October of 2020. It was in kind of the height of the pandemic. At that time, you had all your managers talk to you. We talked to you at the time about how it was a good time for active management, and obviously that's certainly been the case in the almost 2 years since then. And again, great timing on both from a timing of overall market perspective, absolute return as well as relative. So that's the more recent, or the latter half of our experience, of our full 4-year experience with you. If you ask, why, what's part of the reason for the nice turnaround, why, you told us a couple of years ago the market was going to become more favorable, and what has exactly happened. If you look at page 10, you look at our model's performance, you can see that what we're doing is we're taking the Russell 1000 and ranking it this is looking at every month end and saying, okay, take on the left side the 100 highest ranked stocks in the Russell 1000, and on the right side take the 100 lowest ranked stocks in the Russell 1000, measure their return for the next month, and accumulate it. And what you see here, and over this period, to remind you, the Russell 1000 is down 13.6%. You can see roughly half the groups underperform and half of them outperform. And the good news is that the one on the left is the one on the left, the one noted pens or best. Those are the best expected returns. They in fact were the best return stocks. The ones we ranked the worst were in fact the worst returning stocks. So that model has definitely helped prove to be valuable, as well as some of our tilts have helped to prove to be valuable. So maybe just to kind of cut across, I know there were some questions, we don't want to take up too much time, but to kind of cut across to just remind you about our longer term performance. On page 12, we always keep it close relative to the market. We don't win all the time, we win more often than we lose. You can see here on a calendar year basis, and you can see that when we do lose, we keep it close, and the losses tend to be when the market's up a lot. And certainly, we've had some of those years in the last couple of years, which have been fortunate, but you can see we always keep it close. When you keep it close, you win more often than you lose. You get the next page. The next page, 13, shows you that this is obviously on a calendar year basis, on a 3-year basis, this is showing you that 76% of all 12-quarter or rolling 3-year periods, we're outperforming the market. You could also see on the left side of the page that when the market's for a 3-year period flat to down, we always, 100% of the time, we outperform. So you can see that we really do keep it close. So we're outperforming the market more than 3 out of 4 3-year periods. Actually, as it turns out, if you look at the next page, we're outperforming the median manager on a 3-year basis 85% of the time. So 85% of all 3-year rolling periods, we are beating the median manager that's also trying to beat the market. So just to give you a perspective, that's what you get with an enhanced index strategy that's trying to focus on hitting singles and doubles. We're not trying to focus on the home runs, and we're also focused on trying to protect you on the downside. We've done that on a 3-year basis. Page 15 shows you we've done it on a 1-month basis. So that's kind of the history of Prime. The current positioning of your portfolio is on page 16. You can see this page, page 15 shows you that we win in all periods, whether the market's up, down, or flat, but we win the most when the market is down. But this page is your portfolio exposures. Let's look at the right side of the page. Notice the sectors. All the sectors are tight. There's not a sector that's more than 0.5% plus or minus from the market. If you go down on the right side of the page, you can see we're holding currently roughly 180 plus names. You can see that the dividend yield of your portfolio is right at the market. You can see the beta of your portfolio is right at 1.99 to be exact. The tracking error of your portfolio is 1.3%. What that means is that you could expect our return to be within 1.3% 2 out of 3 years, and 19 out of 20 years, you'd expect our return to be within 2.56% of the market's return. So that's what we're doing. We're managing the tracking error to keep it tight, to try and win more often than we lose. Again, in the past year, we've added 1.9%. So we've clearly added a lot of value relative to the tracking error we're taking. Again, the models work well, and the positioning has pretty much worked well. If you look at the left side of the page, you can see the 100 largest stocks in the Russell 1000 represent 62% of the market weight. In your portfolio, they represent 60%. We're a little bit under. We're a little bit under the largest cap stocks. We're a little bit overweighted to the mid-cap stocks. We're also a little bit overweighted to value stocks. We're 53.7 versus 48.7. So we're call it 5% overweighted to value. We're also a little bit defensive. Remember, a year plus ago, we were just the opposite. A year plus ago, we were dynamic. And in fact, the next page, you'll remember we showed you this page before. Obviously, now you'll have a couple more quarters to it. But if you look at this next page, it takes those same exposures or tilts and shows you how it's changed over time. So if you go back to a year ago, say June 30th of 2021, we were at that point dynamic. We were in gray, we were dynamic. Remember, we told you that when we met with you in October of 2020, we said we were shifting from defensive to dynamic, and the reason we did is we knew that the economy was going to open. So the economy was going to open, and when the economy was going to open, we knew that dynamic stocks are stocks with more variability of earnings, more variability in price. Those are probably the stocks that are going to rebound the most, and that's in fact what happened. But again, that was a year ago. We told you a year ago that for the 12 months ending March of 2021, the Russell defensive stocks outperformed the Russell dynamic stocks outperformed defensive stocks by 29%. That's 50% of the market outperforming the other 50. We were on the right side then, and in the last quarter, defensive stocks outperformed dynamic stocks by almost 8%. We were on the right side this time. So these are all marginal shifts. We're not looking to take your portfolio in big directions. We're not giving you deep growth, deep value, absolute value growth. Everything is relative, but we're trying to outperform the market. So that's the overall strategy and how it's changed over time. If there's any time and you care to, I'd be happy to talk about the market environment briefly and talk about inflation and the effects of inflation, if that would be okay with the committee, or otherwise I'm happy to take questions.
I'd love to get I think the whole committee would like to get your perspective on the market, but before you do, we're fortunate we have our city manager, Ms. Curry, is on joining us for the meeting. Could you explain
She
sort of...
dropped off.
She dropped off?
Yeah.
Okay, never mind that. Well, briefly, could you explain to the committee, once again, the pricing structure, which is sort of unique for Twin? That was one of our initial tracks. Could you just kind of review that for us? It's been a while.
Absolutely, please, John, absolutely. And as you know, I referred to it before. So the fee arrangement that we have with the city of Gainesville is that we charge you a zero base fee. We do not charge you a base fee. We charge you only a performance fee, and that performance fee is paid on the return above the Russell 1000 on a cumulative basis, for as those who are familiar with alternative investments, with a high watermark in a sense. Right. Meaning so in the last year, John, while we've outperformed by 1.9%, we're still making back for the first 2+ years of underperformance. So all of this performance has been at zero fees over this period. So it's a very unique experience. You've asked this question before, John, how could we do that? We don't do that with all of our clients. We do not. We do it with only a handful of clients. And to be fair, you'll remember that before ANCO was Summit, ANCO took over for, ANCO, Summit sold to Mercer and at a piece to ANCO, and ANCO took the public business, but we had an arrangement with Summit where we provided Summit with a zero base fee, 35% incentive fee arrangement. So we are continuing to do that. We are very happy to do that. We're also very excited, John, that performance has been much better, and we're excited that within the next year, we hope to get paid.
No.
So we're very excited about that. We are expecting to get paid in the next year or so, but we weren't there at the end of last year, but we're moving in that direction.
Right. And I appreciate that explanation. And now, if you would give us your kind of your perspective on this crazy world that we're all trying to gauge and determine. So please.
Oh, well, thank you. So let's first go to just page 22 for a second, to kind of talk about the environment from the perspective that's also important to you. We'll then talk about the gestalt of the environment, but you know, the city of Gainesville has active managers. You have active managers that are trying to beat the market. Some of them are focused on deep value or deep growth. Some, like Twin, are focused more on an enhanced index or giving you core-like returns. But in all cases, you're looking to have outperformance. And this chart is a chart that you've seen before. It's basically the market environment from an active manager's perspective. In the red bars, you're looking at the percentage of stocks that beat the market over the last 12 months. So you can see that roughly the last 12 months, finally, Brett has come back up. Brett is right now around 50%. Remember that in 2017 through 2020, there was very, very low breadth. What did low breadth mean? Low breadth meant that in 2020, 10% of the 18.4% return of the S&P came from 6 companies. That's what it means. It means that 6 companies out of 500 produced more than half of the market's return in 2020. So in 2020, as you can see, basically only 3 out of 10 stocks beat the market. When 3 out of 10 stocks are beating the market, it's not likely the case that active managers are going to likely win. In fact, the median active manager, large cap core manager, you can see there underperformed by 5%, roughly, for that 12-month period. That would be September of 2020. So now notice the good news is breadth has come up. When breadth comes up, mid-cap stocks start outperforming mega-cap stocks, or mega-cap stocks start underperforming the market, which has happened this year. So I think that from an overall environment standpoint, active management looks like we're on the right side relative to spending the last 4 years or 5 years through 2020 on the wrong side of that breadth chart. You want breadth to be 50% or more. You don't want breadth to be at 30%. You don't want only 3 out of 10 stocks beating the market. If half of them win, half of them lose, that's great. If 60% win, 40% lose, that's even better from an active manager perspective, but you don't want 3 out of 10 stocks beating the market, or even 4 out of 10. It becomes more difficult. So that's the environment from an active manager perspective. Now let's talk about the gestalt, and let's talk about inflation. So inflation, and page 23, and William and Brandon were at the FPPTA in June, the annual conference, and so they may remember seeing this chart that we showed when we talked about the impacts of inflation on equities. But this chart simply shows you the change in inflation. It's not the inflation rate. The inflation rate, you know, is currently 8.5%, but that 8.5% number represents 3+% higher than it was just 6 months ago. So this chart is looking at the inflation rate, the annual inflation rate today minus the annual inflation rate 6 months ago. Because, as many of you know that are in the investment field, what matters is not the rate itself. If we had to live with a 5% inflation rate, we would live with it, and wouldn't like it, but we'd live with it. But what matters more is kind of change in inflation, or change in expected inflation. So this chart is showing you that we have been, for the last year plus, we've been in a rising inflationary environment. I don't need to have the chart show you that. You know that. You go to the grocery store, you go to the gas station, you know you've been in a rising inflationary environment. So this chart is simply saying there's three kinds of regimes, either rising inflation, falling inflation, or stable. So if inflation is changing by less than 75 basis points, plus or minus in the last 6 months, it's a stable inflationary environment. So to your question, John, of what to expect, well, if inflation remains high and we're staying in a rising inflationary environment, then I would tell you that the value side of the market, if you look at the next page, the value side of the market is probably the right place to be. So if you look at the returns of the Russell 1000 Value Index in dark blue, the Russell 1000 Growth Index in light blue, and Treasury bonds in gray, just to kind of compare. I know that your portfolio is much more focused on equities than on fixed, but just to compare, look at all months. 500 months, January of 81, 40 plus years of data, you can see that on average, growth and value give you the same return. I know that you'll have your value managers tell you value is better over the long term. Mary and Brown might tell you growth is better over the long term, but in the end, over the long term, they have the same, over at least this long term of 40 plus years, they have the same average monthly return of, call it 1% or 99 basis points a month. However, overall, stocks don't do as well in rising inflationary environments. Notice that the bars, both blue bars, are at the lowest in rising inflationary environments. Fortunately, they've happened the least often, only 100 months or 99 months of that 500 months, or 20% of the time, we're in a rising inflationary environment. But you see that stocks don't do well overall relative to their history. But relative to bonds, you want to be on the value side in a rising inflationary environment. That's clear. Russell 1000 Value produces twice the return, 65 basis points versus 31 basis points, if it's a rising inflationary environment. If it's stable, which obviously we were in a stable environment for basically a decade, as you saw on the prior page, then you really want to be in growth. Then growth is better. But if it's a rising inflationary environment, if it's a falling, there's a little difference, but not as much difference. So basically, first thing is, if inflation is going to remain high, probably not great for stocks in terms of producing an above average long-term return. It might produce a positive return, but it might be average or lower than average. And secondly, you'd rather be on the value side. Now the next chart is a really great chart to kind of put it all together, to say, okay, why has the market fallen this year? We're not in a recession. Now maybe we'll be in a recession in 2023. Obviously, the yield curve in July, the 210 inverted, and it stayed inverted by 25, 30 basis points. You say to yourself, well, what do we have to look forward to? So this chart is a great chart because it ties in the inflation rate back to 1953 on an annual basis. So now you can see that 8.5% number we recently saw, recently announced. In blue, you have the 10-year Treasury bond yield, in blue. And so the inflation rate you're going to read on the right axis, the Treasury yield you're going to read on the left axis. So let's go back to March of 2020. Inflation, as you can see, March of 2020 is right around 2%, right around the Fed target. Thank you for doing that. You can see interest rates at the height of the pandemic, March of 2020, hit a low of 40 basis points on the 10-year. The 10 years come up to roughly 3%, as you can see in light blue, if you look again on the left side of the axis. So, what's the red line? The red line is basically the inverse of the S&P 500 PE ratio. It's the inverse. It's the earnings yield. It's earnings divided by price. It's how much earnings we as investors require to get per dollar of stock we pay. And so earnings yield, when the red line is going up, that means the PE is coming down. That means that the market is going down. When the red line is going down, that means that the PE of the market is going up, and that means that the stock market is going up. So, I will tell you, this is a highly, highly, highly significant correlation between the rate of inflation, between the 10-year, and between the earnings yield on the market. This is the earnings yield on the S&P 500. So what this says is that if you look at it, usually inflation leads, inflation goes up, or inflation goes down, then the 10-year follows, and then shortly thereafter the earnings yield follows. And so when you look at this, I don't want to be pessimistic, but unless the Fed can get control on inflation, unless that can start to come down and move down, it probably is going to remain a highly volatile period for both the stock and bond markets. I mean, the bond market yield, the 10-year yield has gone from 350 in June down to 265, now it's up to 310 again. So it is highly volatile. Equities, I don't need to tell you, are highly volatile. We've had more than half the days this year. The market's moved by more than 1%. I think that will likely continue until we start to see the inflation rate start to come down to, and we know that the Fed's not going to get it to the 2% level, but if they can get it to a 5% level. So, John, I hope that kind of provides some insight into the overall market. I'm happy to take questions.
Any questions from any? Nope, I don't think so. Jeff, appreciate it. Very, very thorough.
Our pleasure.
All right,
Thank you.
great. Thank you very much. All right, enjoy the rest of your week.
Thank you. You too, everyone. Thank you for letting us do this virtually.
All right, thank you.
Thanks, everybody. Have a good day.
All right. Next on the agenda, as I get back to it.
Can we take a nap break after that?
Yeah.
Wonder what he takes.
I'm sorry if I went too long, guys.
No, you're good.
Thank you.
All right.
It's clearly his passion.
Yeah.
He gets
Yeah.
excited.
Just don't have a heart attack.
I wonder what he drinks in here.
Yes.
All right.
Drinks line graphs like that.
Well, next on the agenda, of course, is Mary and Brown. So you guys ready to go?
Great, yes, thank you, John.
All
I'm
right.
Doug Williams. I see his black boxes on the screen. Doug, thank you for joining us. Doug's on a family vacation right now, but we wanted to make sure that you had the best team here to give you an update from Brown Advisory. So let me do some introductions and some quick updates and we can get started. But John, how much time should Doug and I plan to take?
About 30 minutes.
30 minutes?
Yep.
Okay. And so we'll try to get through this in about 20 minutes, but feel free to interrupt, and then I want to make sure to save like a good 10 minutes at the end for questions and follow-up.
Great, thank you.
Okay, terrific. Well, I've been here before. My name's Mary Gregory, and I know, more than half of you, and I've met a number of you also this morning. I was the relationship manager for a number of years. You invested with us back in 2011. So I've been here with Kevin Austin. I think I was here with Ken Stusen way back when, portfolio manager for the very first time we met with the Pension Review Committee, which I don't think, John, you were a part of it then. So I'm happy to be back here, and I am filling in last minute for my colleague Chris Gibson, who, Brendan, I know that you've spoken to Chris a number of times, especially recently, and others of you may have met Chris Gibson. Chris has decided, and this is sad news for us at Brown Advisory, he's decided to move cities with his family. He's leaving Baltimore and moving back to Atlanta, his hometown, and he has gotten himself a wonderful job with Ariel Investments out of Chicago, and he'll be working out of Atlanta for Ariel. So Chris was going to be here, but I'm subbing in for him, and I will be your contact going forward, so it's full circle back to me. So I'm very happy to be back here in Gainesville. Also on the phone with me is my colleague Doug Williams. Doug has been with Brown Advisory for a number of years, and has recently taken a new role within our team, and that's the role he's presenting here today. Doug is now a portfolio specialist for large cap growth for this strategy, which means he focuses all of his time working with Ken Stusen and representing the large cap growth strategy to our clients, to our consultant audience, et cetera. And Doug has been in that position for probably for some months now, but he has long experience within our team working with clients. Doug in that is replacing Kevin Austin, who left Brown Advisory about four or 5 months ago. And you all have met Kevin a couple of times, and so I know Doug will do a great job, as Kevin has done, talking about the specific stocks. So the team today here is Doug Williams and myself. Again, we're very happy to be here to give you an update, and we just want to say thank you for your more than 10 years of investment with us. I know we've had some changes over time. There's been a time when you all were considering going more passive, and you stuck with active. And I think after listening to the presentation from Jeffrey today and talking about the increasing breadth of the market and that being a better environment for active managers, I think that was a good touch point for me to reference off of. That it's been a very narrow market in the last several years, and that's certainly contributed to our underperformance. Because we are active stock pickers looking at fundamentals. We're not trying to represent the benchmark index or give you that kind of exposure. We look very different than the benchmark, and that's been a bit of a negative in our performance. And for example, not owning Apple has cost us hundreds of basis points over time, but there's fundamental reasons why we don't own Apple. So we'll come back to some of those points. So let me just kick off by going on to page 4. Your investment with us began in 2011 in large cap growth, benchmarked against the Russell 1000 Growth Index. It's grown to 54 million, but during that time you've taken out about 55 million, so there's been a huge amount of market gain during that time of 62 million. I'm going to skip the firm update because that's a lot of words, and I'm going to mention some of those updates on the team page. The firm overview page with a pretty picture just shows how Brown Advisory is growing, both in terms of assets and in terms of number of offices, but our main focus remains in equity portfolios, despite the fact that we're becoming more global, and we have now more more fixed income strategies as well. So steady growth at the firm level and stability. The asset summary shows on the left our institutional strategies, of which large cap growth, this strategy is still a big driver and a big important part of our business at 12.3 billion, and that is invested, that's a lot of institutional assets and pension funds like yourselves, which is the breakdown shown on the right. That's the client type within large cap growth, and then intermediary is really through the RIAs, insurance companies, mutual funds, UCITS, et cetera. There are a number of different ways we distribute this strategy, which has been in place for a number of years. Page 8, the equity research team page. Ken Stuzen is the portfolio manager, and he remains in that role. He's been in that role since he started this strategy well over 20 years ago. Doug Williams, I mentioned, is new in the role of investment specialist, but has been with Brown Advisory for a number of years. And then also a couple of changes to note here. Eric Gordon is now head of equities. For a number of years, Eric was director of equity research. So Eric, you could say, has sort of moved up into more of an oversight role. And then under him, Dan Mooney, who had been dedicated to consumer, has now moved into a director of research role, overseeing the entire research team. We also have added a consumer analyst, Chris Guidry. You see there in the second column, Chris Guidry joined us in 22. Also, Frank O'Donnell joined us in 21. And then in the center column, some new analysts. Sophie Stone joined us on the industrials team in 21, and Joe Pasqualicchio under technology joined us in 2022. We've also been beefing up our investigative research team that now numbers 4 investigative analysts. And then our ESG research team continues to grow, adding 1 or 2 people a year. So continued growth in the equity research team. I will just mention on page 9 some of the highlights of the strategy profile, just to lay the groundwork for things that Doug will probably come back to when he talks about why we've bought certain stocks. So this philosophy, this is a concentrated, growth-oriented equity portfolio based on the belief that we think that that's what's going to outperform. So concentration is important. 30 to 35 names has been our recipe for the duration of this strategy. No change there. And we're looking for companies with good business models, sound, sustainable business models that can produce an earnings growth rate of 14% or better over a full market cycle. So that's forward-looking. That's what our analysts expect the earnings growth will be. in the companies that we own. So that's kind of our bar. So
Mary, I don't want to get ahead of you, but I'm just kind of curious, in today's market, what's the expectations on that hurdle rate of 14%?
we're always looking for 14% or better earnings growth rate.
Okay.
That's what we're looking for. And the market will change over time,
Sure.
and in the short term, it can be pretty variable. But we find that what we're looking for is the long term.
What is the long term for you? What's that horizon?
Oh, 3 to 5 years.
3 to 5?
Yeah, 3 to 5 years.
Right.
And so we stay very disciplined, and we take into account valuation when we buy into names. And just to give you some flavor on that, Ken Stuzen and his team might be watching certain names that they really like from a business model perspective for years before we have a chance to buy into those names because of valuation. We want to make sure we get it at a good price. So I will not go into too much more detail on that, but we'll probably come back to that. And then right here, I'd like to, on page 11, I'd like to turn it over to Doug Williams just to talk about the second quarter, and then we can shift back to look at the year-to-date period, and then more specific stock names and what's affected performance. So Doug, could you pick up on the second quarter, if you can, it looks like you're off mute, you're ready to go, on page 11.
Absolutely.
Thank you.
Yeah, absolutely. Thanks, Mary. Thanks, everyone, for the time this morning. Sorry I couldn't be there in person. But to Mary's comments about sort of this page here, it sort of summarizes a little bit what we saw during the second quarter, and I'll touch on what happened in the first quarter and first part of the second quarter. So year to date, obviously the markets and our portfolio companies have been impacted by many macro factors. And just to name a few, obviously the rising interest rate environment and what that's done to valuation multiples across the board, especially within high growth companies. Inflation pressures and how that's impacting the supply chain, China's zero COVID policy and the lockdowns and how that might impact the Chinese consumer, so a company like Estee Lauder. And then lastly, the ongoing conflict in Ukraine. And again, to my earlier comments, this has obviously impacted sort of the overall market, and the first 6 months of this year was one of the worst starts to a calendar year in the market's history. But it also does impact the underlying businesses that we own in this portfolio, so I will try and tie some of those comments in throughout my remarks, but certainly feel free to stop and ask me questions along the way. But just to quickly highlight this page, I mean, the first half of the second quarter was really a continuation of what we saw in the first quarter, where higher growth companies with higher corresponding valuations compressed as interest rates rose throughout that period of time. Fundamentals did not really matter. We have many companies in this portfolio that really posted what we consider sort of solid earnings results and outlooks, but were not rewarded for their fundamentals. But then if you start to think towards the beginning of May, that was really sort of a shift in short-term sentiment from being focused on rising interest rates to the possibility of a recession. And with that sort of change in focus, we did see fundamentals start to matter more. So we had lots of businesses that reported towards the end of May and the beginning of June and were rewarded for that. So those are just some introductory comments before I jump into sort of portfolio positioning and attribution and some of the top and bottom names that drove performance. Barry, did you want to touch on page 12, or should we just jump right into the attribution?
Yeah, I will. We'll look at performance, and before we go there, does anybody have any questions for Doug at this point before we shift on? He's going to talk much more in a second. Okay, so looking at page 12, this is your full performance record with us, and we're showing here the annualized number, and annualized numbers and the calendar year numbers. So you can see if you look at the annualized, we are trailing on a since inception basis, but we are, over different periods, we're a little bit closer to the benchmark. Certainly the year to date, as Doug mentioned, has been a difficult time, and the narrow market certainly has not been our friend. On a calendar year basis, there have certainly been a few years where we've had some underperformance and struggle, but likewise there have been some years where we've done quite well. So the performance record is laid out there for you, and I know we meet regularly, so I won't go into too much detail on the calendar year. We're just going to focus, if we flip to page 13, on the year-to-date. And just to highlight here, on a year-to-date basis, this is year-to-date through 7/31 showing here, so this is a little extra month. We are trailing the Russell 1000 growth by about 550 basis points through the end of July, and that's all coming from a couple of sectors in particular. Information technology, where you see a negative stock selection number there for information technology, and then also within healthcare. And because this is a very concentrated portfolio, these are all really stock stories within those themes. And I think from this point, I'll just turn it over to Doug to talk more about what's going on within healthcare and the names there, and also within information technology.
Yeah, thanks, Mary. And before we turn to the next page, just to maybe touch on positioning really quickly on this page as well. And you can see that healthcare is the portfolio's largest overweight. I mean, we continue to think that we have a lot of best-in-breed business models that will continue to be sort of leaders in their space, even as we head into a post-COVID world. Our largest underweight is information technology, and to Mary's earlier comments, we're about 12% underweight there, and if you were to sort of dig into the underlying industries that make up information technology, that entire underweight is in hardware and specifically Apple. I mean, Apple is about 12% of our benchmark. We've owned it in this portfolio in the past. We've made a lot of money in that name in the past, but the company does not come close to meeting our 14% growth criteria that we need to be met in order to be eligible for this portfolio. They're really sort of a mid to high single digits grower at best. The last sector that I'll highlight quickly is industrials. We do have a relatively large overweight there as well. You know, and 4 business models within that sector, all of which have done well year to date. So that's been a top performing sector for us. So if we flip to the next page, I'll jump into some of the underlying businesses. L3Harris is one of the industrial companies that I was mentioning. They are the aerospace and defense company, and they've really benefited this year. You can see that they've posted a 14% return through the month of July in what has been a challenging absolute market, and there's really 2 primary reasons for that. One is obviously the ongoing conflict in Ukraine and what that has meant for sort of military budgets in general, and then also the United States military announced a planned upgrade to their battlefield communication systems for the first time in several years, so the company has benefited from that. Brown-Forman, a little bit more of a different business model than some of the other software companies you'll see in our portfolio. They're the spirits maker in Kentucky, so they make brands like Jack Daniel's, Woodford Reserve, Finlandia, etc. This company has benefited as sort of the global economy, travel industry, and restaurants have started to reopen. Obviously, that has increased demand. But also on top of that, there has been definitely a large need for those channels to be restocked. So the company has benefited from that as well. The last thing I'll mention, just as an aside, is that the company has announced a marketing plan for later this year, and in the past that's been beneficial for Brown-Forman. S&P Global, a new name to the portfolio. We added it to the portfolio during the first quarter. And just as a reminder, we do have a 1 in, 1 out rule in this portfolio. Ken likes to refer to it as Darwinian capitalism, where anytime a new name comes into the portfolio, we will sell a name, or vice versa. One, that creates a competition for capital, and it also maintains our level of concentration. It was a replacement for PayPal, and really they're the leader in benchmarks and market analytics. They also have a bond rating business. But what made us really excited about S&P is that they merged with a company called IHS Markit, which was also a large global player in the financial markets and commodities space. So we think that the combination of those 2 things and the fact that they're managed by an incredible management team really bolsters their position globally in this space. Cintas is another industrial company that has performed well. They're the uniform rental and cleaning business. I mean, they just continue to execute on sort of all cylinders. They actually recently reported, I think this week, or the end of last week, I should say, and they just continue to post really strong organic growth. They've been able to create efficiencies within their cleaning processes, and they've also, they continue to sort of acquire sort of mom and pop cleaning services sort of across the U.S. It's a really good way for them to acquire new businesses and tack on additional services within those businesses. Costco, obviously the membership warehouse business, They have sort of industry-leading renewal rate, retention, I should say, above 90%, which just puts them in a really good position to be able to raise prices if they need to, but also they've continued to post excellent same-store sales comps. The one thing that I will mention about this is that their numbers would actually probably be a little better if gas prices had not hiked as much as they have this year. I mean, that's a significant portion of their business. It's a lower margin business, and obviously the demand there has increased, and the margin profiles went down just temporarily as oil prices have skyrocketed year to date, as you know. So let me stop there on the top 5 before switching to the bottom 5 to see if there are any questions.
Those top 5, they're all dividend growth stocks too, aren't they? Strong dividend growth stocks?
Did you ask if they're dividend growth stocks?
Yeah, those 5.
Yeah, I'm not sure if they all pay a dividend, but to your point, I mean, we certainly, while we do run a concentrated portfolio, we do want exposures to sort of different types of businesses within this portfolio. So you can see that, and these are certainly not the classic software growth companies, hyper growth companies at the top of the page. So we are happy to see that sort of the diversification has paid off year to date when looking at these top 5 names.
If I could just add to that, we do tend to be underweight dividend yield in this portfolio compared to the benchmark. If you look overall at the portfolio, compare the dividend yield. I think it's just been kind of an unusual period where those sorts of names, might have held up better. The other unusual thing I think about this page is that the contribution to return is positive on the first few names, and then it becomes negative even on Costco. Costco is a top 5 contributor for us, but it was actually down for this period, and it actually cost us a little bit. So this was more a story of what held up better, because this was just a really, really difficult period in the market. And I know Doug's going to get to the bottom 5 contributors, but when the market's down nearly 20%, something that is relatively flat is a good thing, obviously.
Yeah, I think, Doug, all of those paid increasing dividends, pretty strong increases for at least 20 years.
Yeah, that certainly might be the case. So switching to the bottom 5, Shopify, they're an e-commerce platform. They're really an alternative to Amazon and take a little bit of a different approach than Amazon. They're much more focused on the customer and seller. So if you're a seller on Amazon, essentially you have no control over your brand really. So if someone buys your item on Amazon, it's showing up to your front steps in an Amazon box. They take a much more customer and seller-centric approach. Obviously, it's been a difficult stock for us. I think that we would say that we were too early into this one, and the company's really traded down for a few different reasons year to date. One, it's a hyper-growth company and is traded at a higher valuation, which, to my earlier comments, those stocks were negatively impacted during the first quarter and first half of the second quarter. They also had incredibly tough comps that they were coming up against. So if you think back to April of 2021, as sort of the last round of stimulus checks were distributed, and a lot of people used those funds to buy unnecessary items online, I think that they posted about 110% growth rate during that period of time. So that was a pretty difficult comp for them to keep up with. The other thing, and we think that this long term is going to be incredibly valuable for the company, and that they're in a really good position to do it, but they did announce a multi-year investment earlier this year into fulfillment centers. It was a program that they had been piloting during the fourth quarter of 2021. It was something that was really attractive to their current sellers and a good way to attract new sellers. It gives them the option to, it lets them outsource sort of the storage, shipment, returns processing portion of their business to Shopify. So again, obviously a challenging stock for us here to date. We continue to really like the fundamentals. We've added to the position year to date on the weakness, and we think that things like the multi-year investment in fulfillment centers will just bolster their position if you look out over the longer term. Intuitive Surgical, which is actually the longest held name in the portfolio, we've owned it since 2006. They traded down for a few reasons this year. But again, there's a lot of things that we continue to really like about the business. Hospitals have obviously been dealing with staffing issues sort of across the U.S. and that has sort of created some sort of macro challenges just in the space in general. The other thing that the company recently discussed is that for the first time this quarter, actually, they recently discussed this in their earnings call, is that they have come up against some supply chain issues. So some of the semiconductor chips that they need for their systems, they weren't able to get their hands on as quickly as they would like. The stock did trade down a little bit on that news. But again, I mean, that's just something that is deferred. So instead of a system being placed in June, a new robotic surgical system being placed in June, it might happen sometime during the third quarter. So the other thing that I think is really important to highlight, and back to my earlier comments of owning this position since 2006, I mean, they continue to have no competition. There is no robotic surgical system that has even any type of approval in the United States. So we continue to like their position in the space. Match Group is the online dating platform, so they have platforms like Tinder and Hinge and OkCupid. They've underperformed year to date for a few different reasons, but the primary reason has really been COVID, sort of being put on the back burner a little bit as there's been this reopening and people being a little bit more focused on traveling. That has impacted sort of the engagement within their dating apps as people tend to sort of be more focused on that app in the city that they are living in. We continue to think that, I mean, it's clearly by far and away the most efficient way to date. So we continue to like Match and have added to that position year to date as well. Dexcom is the constant glucose monitor. They are the leader from both a form factor perspective, so sort of the size of the monitor they're able to put on, I think it's about the size of a silver dollar now. They're also the leader from an accuracy perspective. So a lot of really good things going on for Dexcom. They did trade down as they announced a slight delay in their most recent model, the G7. The FDA came back to them with just some comments that they needed to, some tweaks that they needed to respond to. No major overhauls will be needed. It will probably be something that will be approved sometime the end of this year, beginning of next. So we continue to think, based on sort of the underlying fundamentals, the position that they're in, the end markets that they have exposure to, that we continue to really like Dexcom as well. And then Coupa, I'll quickly touch on that. They're the business spend management company. So essentially, they're able to take a lot of different business processes relating to, as an example, let's say if you need to buy a chair for you need to buy 5,000 chairs for your office. Coupa is a great software to be able to do that. They have an online platform where you can actually buy the goods. It's very easy if you're in charge of buying, but you need manager approval. It's all done right there in their system. So they have a great platform and a great competitive advantage in this space. So let me stop there on the bottom 5, and then I can quickly just show some of the activity that's been done in the portfolio year to date on the next slide.
Great. So as an example, would you go back to that, please? So as an example, let's take your worst performer there. What are you projecting there? Obviously, you think you're going to keep it.
Yeah, we continue to really like the fundamentals. We continue to do customer checks to make sure that their customers and sellers are as happy as they can be. One thing that we really like that we think is a huge competitive advantage for them is that you are able to use their services across different channels.
Now, you're not answering my question, which is, where's it going?
Oh, well, I mean, I think as soon as, what is happening right now is that e-commerce growth rates are sort of normalizing. They've gone down from probably 30% to 15%. And as we think over the next couple of quarters, as sort of the e-commerce growth rates sort of come back to normal, we think that Shopify will continue to be a premium grower, sort of 30-35%, continue to attract new customers to their platform, and continue to be a leader in the space. Does that help answer the question?
Are you asking about where's the stock going?
Yeah, why are you hanging on to it?
Yeah, I think you're on, maybe connect what we think the stock might do, Doug, to what you think the company fundamentals might do in terms of earnings growth.
Yeah, I mean, it will certainly continue to be volatile in the next couple of quarters, I think. again, to my comments, as the underlying e-commerce growth rates across that industry continue to come back to sort of more normal rates of 15%, it will be volatile over the next couple of quarters, but we will try and be in a position to take advantage of that volatility, so add to it if we think that it's been hit too hard based on the fundamentals. But I mean, down 75%, we certainly think that there's a lot of upside in the underlying stock.
And Doug, none of those five have paid multi-year dividends. The bottom five.
None of them pay dividends, is that what you said? Sorry.
Yeah. It's interesting, the economy between the top five and the bottom five.
There are a lot of interesting things on that piece of paper.
Yeah. I mean, on the top five, the one with the shortest increasing dividend pattern is Costco, which is about 19 years. But the bottom five is, I mean, it's got to be a message or something like
Well, and over those 7 months, you had a huge divergence in performance between growth and value.
that. Yeah.
So the stocks within the portfolio that have the biggest value lean, if you will, and dividend yield is one of those.
That's kind of what I was getting at
Yeah.
in terms of.
But those would have been detractors the prior year. Any value
Well, which
characteristics.
gets you to the point of it's all cyclical, and at what point is, I mean, you people have been terrible, just terrible returns here. Where in the world are you going, when is this going to bounce back?
So I
When
think,
you, what are we, you're the second worst performer we've got. Why would we keep you? I don't get it.
yeah, I think one of the things that we might want to come back to and talk about in terms of looking forward is the breadth of the market and the fact that the market's been so concentrated over the last couple of years. I think it was Jeffrey who said that like the top 3 names in the benchmark in 2021 provided something like half the returns. And I don't have those statistics here in front of me, but what we're seeing is the market is broadening out.
The top 10 names in 2021 accounted for 65% of the benchmark's returns.
Okay, so
So
I assume that, you know, you people are gonna, if you're the worst now and we stay with you, you'll be the best in X number of years, 3, 5, 7.
A lot
I
of
don't know
people
what
look
that
at it as
is.
a buying opportunity. That is, I mean, it might come across a little too bold for me to say that, but certainly some of our clients have seen this as when a manager is underperforming on a relative basis, but they stick to their process, and it has, you know, borne
I
out
can
over the
understand
long
that.
term. It could be a
You
buying
know,
opportunity.
I'm
So,
old enough to have watched these cycles, I know what you're saying. I'm just trying to figure out, in our role as advisors to the city of Gainesville, what do we tell them? We tell them stick with you, we tell them not stick with you, what? And that's a fair question for me to ask you.
yeah, sure. I mean, obviously, I'm going to say you should stick with us because we're applying the same process and we're looking for good business models with good fundamentals, and Doug has talked about that today, and some of the fundamental reasons a Shopify and a Coupa we expect to recover, and that's why we're holding on to these names. So I see a little bit of an analogy between what we're doing and holding on to some of these names that have underperformed, and what I would suggest would be potentially prudent for you all to consider doing, holding on to a manager that's recently underperformed, but has a really good track record of finding good quality businesses.
Doug, I have a question. I know Shopify brings up, but I'm kind of curious. You added more to that recently, you said. So I mean, that shows that your conviction is high because you're actually betting money there. But I'm curious, the source of that funding, did that come from new cash flows, or did you sell something and then reposition? I'm kind of curious. Where was the source of the funds for the additional investment you made in Shopify?
Yeah, it was a trim from another position in the portfolio, and back to Mary's earlier comments, sort of about how we think about valuation. One of the metrics we look at is a 1 in 3 or upside downside ratio. So typically we'll look for maybe a company that doesn't have as much upside to downside. So we'll trim from that and add to some of the names where we think that there is more upside to downside, like a Shopify. You know, I think almost every name on the bottom of this page we've added to year to date.
Okay. All right. Could you now just go through some of the additions and deletions as well? So.
Yeah, so if we go to the next page, and I certainly want to be mindful of time here. So I already mentioned S&P Global being a new addition to the portfolio. We also added a line in NVIDIA during the first quarter. So Align is the leader in the plastic orthodontia space. They have about 80 to 90% market share in that space. They're the clear leader in braces in the adult category, but they continue to win business from the traditional wires and brackets in the teen category. Actually, I think in 50% of teenage cases, Invisalign would actually be better from a treatment perspective than wires and brackets. So great opportunity in front of Align. NVIDIA, they're the semiconductor company. To Mary's earlier comments about how we will be patient from a valuation perspective, that's a name that I think we had followed closely for about 5 years before getting the opportunity to take advantage of some of the volatility that we saw in the beginning of this year to add to it, or to add it to the portfolio, I should say. And really, they have great end market exposure in fast-growing end markets. So they have a lot of chips that are provided into the AI space, machine learning, data storage, so like Microsoft Azure and Amazon AWS. And then I mentioned S&P Global. Happy to talk about the deletions on the bottom of this page. PayPal was eliminated in the beginning of the year as well. Really, that was sort of what Ken likes to refer to the pig through the python, where the management team at PayPal really altered their strategy regarding growth. So instead of trying to bring on new users to the PayPal platform, they decided that they were going to shift to trying to maximize revenue per existing user. And really that was because so many people signed up for PayPal services during COVID. As people were sitting at home buying stuff online, they were getting sick of having to put in their credit card information every time, so signed up for PayPal. So we decided to move on from that position. Pinterest is the most recent deletion from the portfolio. And, really, we were concerned that in this sort of difficult, choppy environment, that advertising budgets might start getting cut, which they have. And the thought is really that advertisers would try to do everything that they could to maintain their advertising spend on the large platforms like a Google or a Facebook, and cut on platforms like a Snapchat or a Pinterest. So we decided to remove Pinterest from the portfolio again in May. It continues to be a business that we really like. They have a really good mousetrap. They attract eyeballs to their website for a very long period of time. So again, we continue to like the business model. So maybe we'll see it in the portfolio sometime in the next couple of years again. Let me stop there, and then I can, if we flip to the next page, I can talk a little bit about outlook and why we think the future is bright, especially regarding sort of the high quality focus that we have in this portfolio. So again, to my earlier comments, sort of the second half of the second quarter, as investors started to become a little bit more concerned about a recession, fundamentals started mattering more. And you can see that this portfolio outperformed by over 325 basis points from sort of May 10th through the end of the quarter. We saw a lot of our companies reported their earnings sort of end of May, beginning of June, and rewarded for those sort of resilient fundamentals. And if you flip to the next slide, this is really hopefully a helpful picture in showing why we think, to Mary's earlier comments, why we think fundamentals continue to be strong in the businesses that we own. And even some of those companies where we might have been too early, like a Shopify, why we're confident in the fact that fundamentals remain intact. So despite the valuations that we've seen compress this year over year, sales estimates have gone up for all but 2 of the companies in our portfolio. So really that's sort of, and again, that's just taking street consensus estimates, not using our estimates. And again, it shows that year over year, revenue estimates have increased for all but 2 companies in our portfolio. And then lastly, the last slide, and I'll be happy to answer any questions here. I mean, we continue to think that the valuations are really compelling. I mean, as of the end of the second quarter, 75% of the portfolio was trading at a valuation near or below levels that we saw in March of 2020 when COVID had been introduced, and the essentially the world completely shut down, the travel industry, global economies were completely shut down. So, I mean, hopefully these slides are helpful in showing that we continue to believe that we have a portfolio of high quality business models. We're focused on companies that are growing faster than average. A lot of examples, a lot of companies that are growing organically that we think will be rewarded over long periods of time, especially as we look out into the future where we do think that it will be sort of a stock picker's environment, where this choppy environment, where there's negative sentiment, that high quality should matter.
Go ahead.
I got one problem. I'm not sure if this is for Doug or Mary, but I see you got 6 employees in your ESG department. What's a quick summary of your criteria when you're looking at a shop?
For this strategy, Ken uses the ESG research as one of his many inputs, but it's not a driver to his decision making.
This is really, there's no benchmark for ESG. I see you have a
There's-
spirits company and a weapons company. So it
Right,
can't be
that's
that benchmark.
true. We don't have ESG as a
And in an online dating app.
we don't have ESG as a front-end screen or benchmark or anything like that within this strategy. But the team that you saw supports all of our equity strategies, and a couple of them do put ESG more on an upfront basis. So we have a sustainability strategy that incorporates ESG and probably wouldn't be likely to own some of the same names.
Thank you.
Okay, thank you, Carmen. All right. You guys, before, any additional comments, insight, things you would like to share with us before we move to our next agenda? All right. And Doug, let me say this, I know you're on vacation, and I hope you're gonna have a good, strong drink after the meeting, but I do appreciate you taking your personal time to join us.
Still in the AM, but okay.
More than happy to do it. I look forward to seeing you guys in person in the future as well.
Thank you. Okay. Great, all right. Thank you very much.
Appreciate seeing everybody.
Of
Thanks.
course, thank you, Mary. Safe travels back. All right.
Matt.
So, next to my agenda, looks like,
It's kind of expensive.
you're up there. Yeah, all right, okay.
Just real quick, wanted an additional comment kind of on Brown, obviously the valuation and performance. There's another manager that operates here in Florida that has a very similar style, concentrated. They tend to be, have higher growth rates and valuations with their companies and have performed in a very similar fashion. You know, those more expensive companies, essentially the higher valuation you had, the more you got hurt this year. And so their actual stock performance has been quite under. And it was also not great last year, in part because of the concentration issues. We kind of talked about that previously. To some of your questions about performance, what I think is really important, like on page 21, you've got the earnings growth.
Are you still on their stuff?
I'm on their report.
Okay. 21?
Yeah, earnings growth of 21% versus the market of 17%. I think if the situation is maintained, if the fundamentals of their companies continue to grow at the 14% that they're targeting, which is going to be well above the market, then what happens in the next 12 and 24 months is their stocks are significantly cheaper than sort of the broad market, and then the market rewards that fundamental performance. But in the short run, it's just, well, if you have a high PE, we're taking you down.
Yeah, but even looking back, they haven't been, I mean, outside of, I guess, 2019, you know,
It's been a rough slog, for sure.
I wanted to ask her, but she disappeared quickly. Can you find out what they do to look backwards at the growth multiples of those companies that they thought were going to grow at 14%?
And so what's the actual?
And what's the actual percentage they've grown at? And it'd be great if they have it since 2011. They may not. I don't know what they'll have, but I'd be interested just to see it. All right, here's all the companies we put in the portfolio. We thought they were going to grow at X. What did they actually grow at?
And when? Because it's a timing issue here with, you look at the value and the growth and all that stuff, and the growth, we've got 3 here that are relatively heavy growth, including the overseas. So these people have taken a hell of a hit over the last 18 months. I mean, that's just look at it, this is the way it's been. But may be our leaders somewhere down the pike. My question is, how long do we hang with these people? How often do we, as a group, suggest a rebalancing within our portfolio? And that's, Williams' department, he talks about that. But at some point, you want these people to have them, all three of them. They're going to do great. But when is that? Well, if we're about to go into a recessionary period or a stagflationary period, they're not going to perform very well.
So what's the prospect of them going on a compensation, a performance compensation plan like Twin?
I don't think they will. It's actually interesting you just brought this up because there is sort of a little bit of an update relative to Brown. They reached out to us a couple of months back because of a triggering of a most favored nation. They brought in a new client, and so they reached out because it essentially was going to trigger a lower fee for you. And so I had a little back and forth. The short version of that conversation is it was cheaper today, but was actually going to be more expensive in the future, assuming assets rebounded and grew beyond a certain level. So I kind of had this discussion with them. I said, well, this is great. It's great that it saves money today, but it has the potential to be more expensive. So then they agreed to essentially put in a lower tier in the future. So it's cheaper today and then does not get more expensive in the future. You essentially just maintain your early savings, if you will. So what that meant was you're 54 million today. You would save money versus the old agreement until you get to 90 million, and then beyond 90 million, it's neutral. So it's the same.
I mean, one way of looking at it is Dave earned his salary today, and so they're teeing this thing up. I would imagine they'd be more negotiable.
I mean, we can ask the question.
Yeah.
I don't know.
Well, I'm probably too quick to get rid of people. I'm looking at 10-year numbers, and it's still like 4 points above what our funds return, even though it's almost 3 points behind the benchmark.
Yeah, you have the allocation decision by style, then you have the actual relative performance within their style.
Growth versus. Yeah.
So you look at their numbers, especially after today's report. I mean, it jumps out, the red jumps out at you, and it's a completely legitimate question for us to be asking. And I biases toward quality, and just looking at their portfolio holdings, which I spend a lot of my time looking at other managers who I really like and kind of see what they're holding and kind of cross-reference it. But a lot of their holdings, I see in other managers, both value and growth, that I have a lot of respect for. Now, when they bought it, I mean, time could have been atrocious, but again, just a quick intellectual look at, the quality portfolio I think is decent, but again, like, Shopify, I was talking to the manager yesterday, they said they like Shopify's business model, and they said, but the valuation absolutely no freaking sense, and so they didn't buy it. And 74% decline kind of concludes.
It might make sense
It
now.
didn't make sense. So I get the hurdle rate. I think all the growth managers, you want to get growth, but again, the key is if you pay too much for that growth, it may be a great company, it's just going to be a crappy investment. And you can go through a portfolio, and every manager's going to have their
Any
secrets.
growth portfolio,
So,
But my question remains, how often do we as a group want to redo the mix?
Right. Well, didn't we did the rebalancing is one thing. When I think you want to take from the rich and give to the poor. Statistically, that's a really good win, over 3 to 7 year time frames. And so maybe you want to speak to the rebalancing process.
Sure. I mean, we've got the investment policy statement that, we've got targets and we've got ranges. So we typically are not going to rebalance unless we have a specific issue, as long as we're within our ranges, our target ranges. Now, having said that, actually sometime over the next 3 to 4 weeks, 2 to 3 weeks, I'll be withdrawing money from the investment managers. And, when I do that, I'll look at, who's most over target, but, given Brown's performance and the growth manager, everyone's down, but some are down more than others. So, and I hate selling at the bottom, but, the overall impact on the portfolio, we've got, looking at the portfolio these days, not quite 700 million, or not quite 600 million. And I'll probably end up taking 20 million out in cash, maybe 25, it depends. We're still having issues with our accounting department being able to provide me with accurate trial balance numbers. And, but in any event, so the impact on the portfolio, even if we are selling in a down market, is not that great. You're looking at most of, taking 3 or 4% of the portfolio out. And so, yeah, you'd rather do it in an up market, but if an event like this occurs once every 10 or so years, that's just the way it works. I'll have conversations with Brendan, and we'll look at who's over, who's the most over their target, and we try not to intentionally time the markets. So we're not going to say, well, let's take it more from value managers or growth managers unless we think that there's significant reason to do that. So, we'll see what the markets do over the next couple of weeks, and we'll make that decision. One thing I'd point out about Brown, and it just kind of goes back to the same issue that's underlying growth managers and large cap growth in particular, is that they're fundamental managers. They're looking at fundamentals, and that makes them, more defensive, I think. And they're looking for quality companies, and it's hard to keep up with the index if you're doing that, because the index, if they're not going to own those FANG stocks or whatever acronym you want to include, they're not going to perform. I'm disappointed they've underperformed as much in a down market, but like Brenda was saying, if you had the higher valuations going in, they took you down more, and that's just the way it is. And I'd point out, yes, they are relatively, there are only, if you go back to the 10-year period, they're the only manager in our portfolio that has negative relative performance, a couple hundred basis points almost. But at the same time, they're our second highest performing manager in the portfolio. So, the question is, and we've been looking at this, I think, as a committee over the past couple of years. Brendan has put together comparisons of some other large cap growth managers, and maybe we can take a look at that again at our next meeting, just to show you what sort of.
And the highest rated one is the other growth one, and it's taken a hit lately. And yet, my expectation is that given time, it'll come back. I wish I could tell you what I think my time frame is, because I don't.
Well, and I think, Twin got into this, and I'll steal their chart again, talking about market breadth. But when you look at this period in the late 90s, we saw, this is really the last time the breadth was this negative, what we've experienced just in the last, 18 months.
Well, okay.
Yeah. So we've had this negative breadth back in 20. Back here, in the growth benchmark, the top 10 stocks got to be, I'm going to get this wrong, but something like 34-35% of the growth benchmark when this was happening, when breadth was negative. And then what happened for the next 7 years? You had breadth go north of 50 and stay there for essentially 6 straight years. You had the top 10 in the growth benchmark go from 35 to 22%. Because the Cisco's, the Intels, those ones that had become the largest beast, struggled. And active managers generally did very well for the next 6 or 7 years. Not all, certainly, but just, if you took the averages, more than half did better than the market. So kind of now here we were again, now for a much shorter period of time, but now the top 10 got to be north of 40%. Not just 35, but north of 40%. Apple and Microsoft, the two of them by themselves were 25% of the benchmark. And we're in this negative breadth scenario. So if, the last time it was like that, you end up having a fairly lengthy period where that was kind of unwinding itself. And my expectation is, again, in a similar fashion, not to say that it's the next 7 years, but maybe it's the next 3 or what have you, that situation
Then
tends to
you're
unwind
right.
itself.
The question is, when will it start? And what are our responsibilities between now and that start date to manage this portfolio? That's the question in my mind.
Would you, now you two guys consult when William has to take funds out.
We'll talk about.
And you figure it out strategically. But if we all sort of kind of think the market's low and it's going to come back but not quite, why wouldn't you generate some of the cash that's required by the city by selling calls, out of the money calls? Because you think it's going to come back.
Well, we've looked at that strategy in the past and we've never, well, I mean, first of all, that's an open-ended, there's unlimited downside for writing calls.
No, I'm saying write them above the current price.
Yeah. But when you write it, I mean, if the market goes up,
Yeah.
then
You cap your gains.
You cap your gain.
You cap your.
Yeah, but I mean, you're going to sell them now at a low, and so you're going to take your losses. I mean, what's to lose selling them 10, 15% above the current price and generating cash out?
I mean, I would say that there are some plans that
Yeah.
kind of have looked at that. Generally speaking, very few employ that strategy.
Okay.
It gets complicated because you have to have a manager to do it.
Mhm.
You have to have some strategy. And pricing can vary dramatically. And so, for those that tend to look at it, what you'll tend to do is have a more continual process. It's more an investment, like an overlay strategy, where you're always writing calls and doing that to kind of create a little bit of a collar. But again, when you factor in the expense, when you factor in everything else, most plans just don't do it. That's kind of the short answer. But it's certainly.
Is it permitted in the investment policy statement?
See where the risk is.
Probably not in the current policy, but that could be changed. But again, you'd have to sort of incorporate it with like a manager, with a strategy that's going to come in and actually be implementing.
correct. And we have a manager on police and fire, parametric, that provides that type of service. Right now, we're not using them for that on police and fire, on the police and fire pension. We're using them to do a cash overlay. And I've got mixed feelings about that. But they also provide a strategy where they can write calls, and they can do the other. They'll do multiple types of option strategies for you, and some to generate income, others to be defensive in down markets.
Yeah, I'm not talking about strategic, that kind of stuff playing with, because that can get dangerous. But simply selling calls, when you take a consensus here, that we kind of think it's down, but as David says, you don't know when it's going to come back, and you're going to hit them, you're going to sell them 10 or 15% above the.
I don't know, the timing, if we were going to do that, I don't think I would do it in a down market where we are now, because it depends on how things play out over the next six months to a year or two. But, I would do it in a market where you've had good returns for a while, where there's less upside potential. Not that there's immediate upside potential in these markets, but when you're down 10% or whatever year to date, you're more down than you are up. So I wouldn't want to sell away upside potential that we might see over the next 6 months to a year.
But that's what you're going to do if you sell holdings today in order to generate that cash. The only opportunity if you were to sell calls.
Yeah, but we don't have a choice in that matter. We have to, we allow the cash in the city account and the pension plan, city accounts to go negative during the year in order to earn returns on it. But we have to true it up and get it and make it positive for fiscal year end for auditors. So that's why I take cash out at the end of the year.
The other consideration, obviously, you have, say, fixed income, which is we're mainly talking about equity. Now, of course, the fixed income is negative too, in this somewhat unique environment where equities are off the way they are, fixed income is also off. So that's also not the same type of buffer that it has been in the past. But the other side is you're also low already on the fixed income allocation. So if you take that down, then you're shrinking that cushion even greater. you know, when we did the pension obligation bond, the idea was they did get, fixed income did get a little funding, but it was really just with the idea of, in a horrific environment, to give us 12 months of cash flow. You know, that annual, you know, payment that needed to come over.
Yeah.
And that's kind of where it has stayed in terms of its relative allocation. So now if you then draw it down, then you're well under 1 year's cash if you were to need it in that extreme environment. So that was kind of the rationale for how we did the, you know, the placement of that money during the POE.
And we'll look at fixed income. I mean, that will probably be one of the primary sources we use because there's just less upside potential there.
Yeah.
It's also one of your smaller pools from which to draw on. Yeah. Which is the point you were saying. And again, whatever you do with that's fine with me. It seems to me if you could divide that 25 million, if you take it out of these growth areas, that's fine for now. But maybe 12 months, 18 months, 24 months from now, we need to readjust so that some of that value stuff goes back into growth, because then they are going to be on the cusp of doing something. Is that a fair comment?
Yeah.
And is that something we do or you do, or how do we?
Well, I mean, I think the committee would need to discuss it, and you know, in the past, we've stayed away from making sort of tactical style
Sure, because the
allocations.
only thing you can guarantee is that we'll make a mistake.
Right. But, you know, that's not to say we can't have the conversation and talk about it.
No, I understand that, yeah. If I thought I had a really super crystal ball, I'd tell you, but I don't have anything like
We had a
that.
crystal ball. none of
Yeah,
us
I'd be
would
calling it my
not
eye.
work anymore.
Well, to Dave's earlier point, it just, if somebody independent picks up the report and says, what are these idiots doing owning a manager that's underperformed their index, even though it's the second highest performer? You need to have, I think, a quick, rational, well-grounded, you clearly, we pay you to monitor this. I think, and I don't want to put words in your mouth, but when you look at other large cap growth managers with a similar investment style, so they want high return, but they're sensitive to valuations and fundamentals, where there are some that are just purely momentum and they don't care. Given the universe, and why we hire them, is because of those attributes. One, have they drifted from their attributes, number one, if that's important. But number two, are there other, if we want to date a brunette, are there other brunettes that are much prettier than brown, or are they about as pretty as we have in terms of that style?
I think relative.
I like your analogy, it works. I can
get that, okay.
And interestingly, I just ran this for another client as a different large cap growth manager. But the short version is, Brown has probably done just a little bit worse than the average of that lot. All of them have underperformed for the last 5 and 10 years. Now, they haven't underperformed for 10 years, but their performance in the last 2 years has pulled down that trailing 10 year. So, you know, when you look at our report, you look at 10 years, and you're like, wait a minute, we've been sitting here underperforming for 10 years? No, it's the fact that the last, 12 or 18 months, they're 1,200 behind, that has turned those long-term numbers, negative. And so, again, when we talk about the concentration issues, we talk about the valuation issues that we've all talked about, but I look at these other managers, some are similar to Brown, some are more aggressive, some are more diversified. When all of them are under for 5 and 10 years, it tells me that it could continue. It's possible, but a lot less likely. And so that's what ultimately gets back to, if the fundamentals are in place, if the strategy's in place, I think we're closer to this turning a corner, and you start to get the positive side of that active management and those, that criteria that's being reported.
I think the only risk we have, and we just need to make sure we document, is that, as John pointed out, and I'm not a benchmark hold guy, like, I prefer active management personally, but I think we need to document that hey, we have active managers, here's why we have them relative to owning just the Russell 1000 or whatever the benchmark might be. Because we could do that easily, right, for very cheap. I don't think that's the right decision, but I think we need to make sure that we have something that says, here's why we've done what we've done, and obviously document that process. Because John's right, anybody looking in, the two managers we heard from today, both are underperforming their benchmarks. And that's relative, obviously, it hasn't always been that way.
As
But
we
that's the
mentioned,
risk that-
I'll bring back kind of in particular the growth analysis, because I think this is the one that stands out the most. We did have this conversation not all that long ago, but we'll update it and look at it again. And again, it all comes back to your point. If somebody else on the outside is going to criticize the decision, you can, no, look at the minutes, look at the notes. We looked at it here, we talked about it, and then we did it again and again. And it's an active decision, as opposed to just looking up 5 years later and said, oh my gosh, this has been awful the whole time, why didn't you do anything?
Well, and, because we focus on the long term, if you look at the since inception numbers for all of our active managers, except for Brown, they're all positive. And so, that shows people why we've chosen active management pretty clearly, I think. And, Twin being an enhanced index, I don't know if you want to, really consider them active. They're somewhat active, but, and we've had them only for a few years, so
Well, they're free, so I mean, heck, keep
Yeah.
them.
Cheaper than the index, right?
We had like 20, 30 basis points right off the bat.
I think it's good discussion, and I appreciate it. Yeah.
Are any funds, if you need a safety net, and granted, we'd rather be 100% invest the right way, but if you need a safety net, are some people moving away from bonds and getting into real estate to get into 5 to 6% range?
Yes, I mean, there's certainly funds that have moved, well, in the last 6 months, I think it's less an active decision moving into real estate. It's more of a, for those that are already in real estate or had previously committed. But for those that are already in real estate, which you have a piece, it's become a much larger slice of the pie, because in the last 12 months, real estate's up 30%, and everything else in the portfolio is negative. So it has naturally become a larger piece. Now, for funds that are in that situation, the conversation to me is more about, do we rebalance? Do we harvest some of these profits and go back toward what our target was? Or do we say, look, we think real estate is going to continue to do well, fixed income, these other assets are going to continue to struggle, so let's reset our target. If we were at 10 and now our target was 10 and we're sitting here at 15 or 16%, do we just reset the target to 15 and call it good? In core, I think there's likely, you're going to see some compression there. I'm not predicting a negative 20 or negative 30% in real estate, but I think it's going to come down pretty dramatically in the next few quarters, probably into the single digits. And I was actually going to bring this up a little later on in the discussion, but I wanted to gauge your interest about looking, because again, with rising interest rates, kind of the end, or I'm assuming at least a slowing down of this real estate cycle, in particular kind of in the value add opportunistic part of the market over the next 3 to 4 years, I'm expecting there to be more opportunity than certainly there has been, because again, the way prices have been going, it's been harder to find some of those, more challenged situations and turn it around and make money. So one of the thoughts was to just gauge your interest, and maybe if there was interest over the next couple of meetings, potentially look at looking at some additional exposure into, again, not just core real estate, because that's run up incredibly, but in some of that value add opportunistic part of the market, if there might be some interest.
Tell me where employment's going and I'll answer that question.
Got another truck going to that. For the moment, it's okay.
In inflation, houses are out, apartments are in. There's nobody can afford houses.
Tell me how employees are gonna work, and I'll give you.
That's what I'm saying, tell me how employment's gonna go.
I mean, generally, my position would be, I certainly think unemployment is higher 2, 3, 4 years from now.
It's gonna have to be if we're gonna be in a recession.
Right. And I think that's what I'm kind of referring to as the opportunity. Not buying into opportunistic today and owning it, because then your comps go down. But, over the next, say, 24, 36 months, being in a position to deploy money into those markets when, not necessarily even nationally, but in certain cities, you have, a worse unemployment situation. So all of a sudden you have more opportunity and dislocation in those real estate markets. Somebody can come in and buy a property 20%, under market, turn it around and make that money, as opposed to just sort of a buy and hold strategy. And so again, and I could be wrong that that's does the environment, but it's just, again, I can see how we could be heading toward a period where there is more opportunity for that type of investment than there has been.
But then there's the question of how you buy it, even if you are. Are you gonna go into the public REITs or private equity? I get a little shaky on private equity in terms of valuations and everything else, but very positive about the REITs. And it's a highly segmented market. How do you feel about farmland compared to office buildings?
Do you do REITs or do ETFs?
Yeah.
Because you don't have occupants with ETFs.
And that becomes the other question from an implementation standpoint. Over 15 years, I think you get the same returns. Public market versus private. But your ride along the way is a lot different.
I'm always sketchy about the valuation stuff. I mean, I like a market price as opposed to some appraiser's determination of what that shopping center's worth.
It's independent, what are you talking about?
Yeah. Get three of them, what does that cost?
But all of that is, those are all important considerations. Again, if there's even interest in the first place, obviously we don't need to get into the vehicle difference if we're not interested in the asset class. But if we are interested in exploring it, those are all important characteristics that we have to go into it.
Now, what about something like principal, wasn't that the do any of those ever convert to REITs?
Not in those type of vehicles, no, because that is designed to be a private vehicle. And quite frankly, for most, especially a public pension plan, that is our preference. Is to have a private vehicle as opposed to a REIT.
Really?
So very simply, again, we expect the returns to be the same over 10, 15, 20-year periods. The difference is in the valuation. You've got market valuation versus private market valuation with actual appraisals. Okay, and I'll use 2009 as the perfect example. 2009 or 8 to 9, the average REIT lost 90%. And then 12 months later was up 110. Does that mean the real estate actually went down 90 and went back up 110 within 24 months? No. It's because the market was freaking out and just said, hey, if it's liquid, if I can push a button and sell it, sell it. And that's what happened. But on the private market side, they're doing valuations, it's slower. Now ultimately they did have 25 and 30% price decline, so there were real price declines. But the other thing is it was later. And so from a pension plan perspective, if you've got your real estate asset that effectively prices itself with equity, then from a price standpoint, you're not getting any diversification in the short run. So in 2009, when your equities are off 25%, all your real estate's off 25 or 30 or 40%. And so everything you own is down at the same time. Where on the private side, because of the way the valuations are done, because of the lag, equities sell off, your real estate's holding up. Then your real estate starts to show the signs, but your equities are rebounding. And so you get more of an offsetting impact. Now again, we could talk about whether that's better or not, but I think from a funding perspective, from a return perspective, it helps smooth things out a lot better than on the REIT side. And again, at the end of the day, if you get the same rate of return, why not get the positive of the reduction volatility to go along with the same return? I think that's kind of the idea.
I think it's good. I don't think we're ultra capitalists, but if we expect, if there's always this disruption in the markets, so if we have a strategy that can exploit that in the middle of it, which is always tough for the investor, right? It's pulling the trigger when there's blood in the streets. But I think having, as I think I've used the analogy, having strategies sitting on the shelf that we've vetted and pre-approved, and if the dynamics, warrant us exploiting that, whatever situation's going on, I think having that vetted and having it sitting there will help what's already around a slow-moving decision process a lot better. And if we never use it, it just sits on that shelf, but at least we vetted the company and so forth. I would be in favor of taking a look at that. I don't think there's anything long short. Obviously, the shorts would have been probably better to own 6 months ago, but still, I just think there's a lot of business models that are still kind of questionable whether they're gonna make a long run. And I still think there's a lot of blood yet to be spilled. I can take advantage, benefit from the blood being spilled. I'm somewhat intrigued. I would say with Brown, just to wrap it up on Brown, which is, it's important, we had discussion. Obviously, you're monitoring it, staff's monitoring it, you know, we're raising it. I think anyone looking at the record saying these guys are slipping the switch would be easily discussed that we weren't. Like any organization, we see departures and a lot of staff changes, that always, my little antennas go up and, you know, wandering. So obviously, you've had some people, the big organization, people, lifestyle changes. To your evaluation, are any of those staff changes, are you seeing an acceleration of staff changes at Brown that we ought to be concerned about, or any key people that departed that would diminish their ability to do what they do for us?
No, I mean, certainly there have been departures, and quite frankly, we've been seeing this across the universe, not just in growth, but other managers, you know, given the portability and the ease of changing, we've seen a fair amount, but there's nothing that is overly concerning with Brown in terms of key people. And again, changing of the strategy, changing of the process is really, obviously, part of that is personnel. If key people are leaving, they're naturally going to change the process, but we haven't seen that.
Good, thanks.
Do have a couple items. I'm going to motor through them very quickly. Just touch on a few things. So first, in the big book, June 30th, I'm actually barely going to touch on the performance because it's old news, but I did want to include one news item. Page number 4. As you might recall from our sort of annual report, we have a letter from our CEO, Mike Welker. And essentially, the short version is we're committed to reinvesting 100% of the profits back into the business. And that primarily takes two forms, personnel and technology, with ultimately the goal of providing better service, having better team, more trained team, having better technology, that better service and performance for our clients. So on page 4, we detail there's an organization called Coalition Greenwich. They're one of the big provider of data analytics to the financial services world. And one of the things that they do is conduct an institutional client survey. In 2021, the survey year, as part of that process, we were awarded the Greenwich Quality Leader Award. One, wanted you to be aware of that, something we're certainly very proud of. And again, hopefully, you know, we see it as sort of a tie-in in that reinvestment effort. Reinvesting in people, reinvesting in technology to try to improve all of those service-related items that were being captured kind of as part of that survey process. So again, just kind of wanted to tie that together. Obviously, it's a news item that we're very, very proud of. Just wanted to make sure you knew as well.
Cool, thank you.
The other thing, you know, again, we already kind of knew these performance from last time. Did just want to touch on page 18. So we outperformed ever so slightly, but in a huge negative environment. We're down 12.85%. But notice the universe percentile, the 98th percentile. Again, interesting, as you move down the page, you'll notice your U.S. equities outperformed very nicely for the quarter. International outperformed, fixed income outperformed. Real estate was just a little bit behind, but your components on a relative basis were doing well. But the sum total did not do very well relative to the universe. And if you flip to page 22, I think you already know the answer as to why this is, but I think this just sort of graphically shows you. So the first bar on the left is the U.S. equity exposure. You can see you're in the 3rd percentile. So we have more domestic equity exposure than our peers. The next one over is global or non-U.S. Again, more exposure than our peers. So in a period where equities were selling off 13 or 14 or 15%, if you have more than your peers, obviously that's a detractor. And then the last one, real estate, which is that's third from the right, we're up to 5.7%. So it's actually been an increase because of that issue that we talked about earlier with performance. But that's in the 83rd percentile, where the median or the average fund has over 10%. So you have essentially half the allocation as the average, and that's the one asset class that's really made money in the last year. So when you kind of combine the over equity and under in real estate, that's why we're in the 98th percentile. Now again, what's not discussed here, real estate didn't do well last year, and equities were doing fantastic. So it kind of reversed itself. Plans that did really well last year got hurt this year. The plans that were relatively underperforming last year did well this year because of that reversal. That's really everything that I wanted to highlight in this particular book, because again, this is stale news. So then I wanted to just touch on the July update. So as of June 30th, I'm on page number 2. We were under 600 million, well, 590. But you can see the rebound on the left side to July 1, over 630 million. So obviously, in dollar terms, a very nice rebound. You can see kind of the allocation effect and impact and so on. Down on page 4 now. So we're up almost 7% for the month, ahead of the benchmark of 6.03. But interestingly, a little bit of a reversal. We underperformed in domestic and then in real estate. We did outperform in international or fixed. So we outperformed, but that was more a function of, again, being overweight to equities and getting more of that rebound, even though our domestic managers on a relative basis did just a little bit worse than the benchmark. Most important.
And the timing issue.
Sure. Again, I'm not concerned about it, but just it's an interesting little nuance where you look at the quarterly and it's like everyone did great on a relative basis, yet the fund struggled against the universe. And we had a little bit of a reversal. Some of the managers didn't do as well on a relative basis, but the total fund outperformed. And fiscal year, obviously not where we want it to be, negative 19, behind the benchmark. So obviously still some work to be done. But again, somewhat offset by what was a fantastic year last year.
What is our current assumption rate on our general plan?
I'm sorry.
Our assumption rate in the general plan now, we've been working it down.
It was 7.9 for the fiscal year 22 val, we're going to 775.
Okay, and where do we ultimately, where's sort of the current ultimate end? Is it 7.5 or where, is that yet to be determined?
Well, it kind of depends on how the state reacts to 775,
Got it.
you know. So
How do you expect them to react to 7.75?
I think the state wants every plan I think the divisional retirement wants every plan in the state to be at about 5%, as far as I can tell.
Okay.
But, you know, as long as our long-term returns are, you know, close to 10%, I don't see any reason, you know, to do that. And we'll argue with them about it. And, you know, we have the support of the actuary and the consultant, I think. There's definitely going to be, you know, more pressure to go lower, and we may do that. It's just, you know, it's expensive to lower the assumed rate of return.
And the good news is, you know, as a general plan, the state doesn't have the same carrot that they do on the police and fire side.
Can't hold back money.
So if they don't like your assumed rate of return, they can choose to not accept your report, which then means they don't send the state monies, is what we call them, the insurance tax premiums. And so they have money that they can effectively withhold from you, which is not an option they have, because they're not sending the general employee plan any money.
It's Chapter 175 and 185 of the Florida statutes. It's insurance premium tax money that is collected at the state level and then redistributed to police and fire pensions around the state. We have to submit this detailed annual report to get it. It's a huge pain, and I don't even think it's worth it. But they get about 1.5 million a year from the state. So that's money the city doesn't have to contribute.
What ramifications do they have for general?
None.
Zero.
They can claim that they will withhold state revenue sharing, but that's not the same department. So it's, I mean, of course, Gainesville's kind of on the radar, not in a good way, so who knows?
Wasn't your fault here.
No.
Then I just have two other quick items, one that you've seen before. I'm sorry,
Go ahead, no, you're good, you go ahead.
Okay.
You're good.
A couple of just loose handouts. One, you know, Matt, you kind of brought up the unemployment and inflation numbers, so just kind of an interesting talking point. So on the far right-hand side, you can see we now have had the last 2 quarters turn negative. So which traditionally is sort of the benchmark for cueing a recession, but officially it hasn't been declared yet. The other thing that I think is interesting, if you look at this particular chart that goes back to 1947, every time you have a gray shaded area, which is a recession, look at the green line or the unemployment rate at that time or over that period. You have every single time the unemployment rate is going up pretty significantly. Now, to this point, down in the far right-hand corner, our unemployment rate is still flat to negative, at least for the time being. And I think that's the one thing that's so kind of different about this particular environment. Typically in negative, you've had negative growth, you've had an inversion of the 2 to 10, you've already had unemployment rising. Here, it's been incredibly stable. And I think that's the main component why we haven't really had a recession officially declared. The question is, 3 months from now, 6 months from now, are we going to see that button hook and start to move higher? I think that's ultimately the.
Are they gonna do 50 or 75 basis points?
Well, we're not going to declare a recession this year, let's just fix that.
Yeah.
That's the reality. Whether we are in one or not.
Only for my money.
I mean, if the definition is negative growth for 6 months.
We're in it.
You're in it. Right. To answer your question, the last I heard is 75, but obviously that gets priced differently every day. But again, the bond market is already priced that in. The real question is if inflation CPI has already started to roll, from 9.1 to 8.6. Lumber's way down, fuel is way down, so a lot of the pressure, I think, not that we're going back to 2%, but I think the immediate significant pressure has started to peak and is starting to wear off. If CPI continues, it goes from 8.6 to 8.2 to 7.9, then I think the Fed, there's an argument, can relax a little bit. But if CPI stays where it is, 8.6 goes back up toward 9, then they probably come out with another round of interest rate increases. And I don't think the market has that priced in. But again, the good news in the short run, and you can see how the market has reacted the last 6 weeks. Since CPI started to come down just a little bit, the market has reacted very positively. Because again, they don't need the rate to be 2%. They just need it to stop increasing.
Do you think the student loan forgiveness movement is going to have any significant inflationary pressure?
I don't think it will be significant. My guess is it would be slightly inflationary. But I think that the number I read was $300 billion.
Yeah.
And when you consider the amount of money that has been thrown around for the prior 3 or 4 years, which is in the trillions, I'm not sure 300 billion, and here's the other thing too. It's forgiveness that would have been paid over the next 3, 4, 5, 6 years. So it's not like
money being spent in the economy.
it's not money that all of a sudden is in somebody's hand. It was just a series of payments that they no longer have to pay. So yes, I do think it's extra money, but it's not a lot of money today. But just from an aside standpoint, the thing that I find interesting, if they truly get to forgive, I'm not sure it actually goes through. But we just had a whole bunch of students start this month, and all of them are getting federal loans.
Yep.
So we're theoretically forgiving these outstanding ones while handing new ones out. It doesn't make sense.
I think legally it's a stand.
At least stop giving them out. If it's a problem that you need to forgive, you should probably stop doing it. But we haven't addressed that particular.
The larger question is with the national debt going in the wrong direction and interest rates going, the debt service on the national debt has to be increasing incredibly. I just got a mortgage, and so you know what debt rates are like. And at some point that starts crowding out government budgets, the debt service. But you don't hear anything about that.
Yeah, not in the current environment. And I think, again, still where rates are, it's not a huge issue yet, especially when you consider global rates. But if it starts to get, north of 4.5%, 5%, it really starts to bite. So it does present an issue. But yeah.
Student loan debt is more dangerous, I think, politically, or is when you start abrogating contract law.
Hey, man.
Yes.
You're setting up an expectation of, hey, it doesn't work out for me, I'm just going to walk away. And that, we've already done that too many times, and my concern is you start building a culture of property rights and contract is not going to be honored. That is a dangerous precedent in a market economy. And that's what I think it's clearly unconstitutional what's been offered so far. But long run, we're, last 10 years about contracts. That worries me when you get a political pressure to, oh, everyone's suffering, let's just, screw him because it's not fair that they, sorry you can't pay your bill. And it's hard. I mean, there's people, IT&T, some of these private universities, they absolutely defrauded students. So I'm thinking, take those guys out and shoot them. Don't break every contract. But that's my concern long run. But we'll see.
Well, the owners of all those for-profit schools,
Yeah.
they made all their money.
Well, see, that's where they ought to be sitting in prison, in my opinion. But that's,
And then there was the guy who paid for his children and
That's
is now
the one
paying
I-
for his grandchildren. And then there was a confrontation.
He's doing the right thing.
Yeah, with Senator Warner.
Right.
And, I paid for my children, I felt like that was me, and the guy
I
said,
totally understand that. So we'll see. I mean, we could probably, we can't solve it, but it's, but I think we're doing the best we can. Certainly, with this court, we advise on this, and I just appreciate, one, the talents and skills of everybody here volunteering your time. Everyone is busy, but, I love this group, and I love the intellect and the questions that we're asking, and I think in an uncertain world, we're doing the very best we can. And I'd be very proud to stack up our decision process with anyone that ever would like to understand it. So, with that, thank you, everybody, very much for your continued service. Anything else administratively?
Just the fact that, again, you've seen this 100 times, but the most recent updated version is in front of you. Don't need to go through it.
Well, I love the second page where it shows you missed the 15 best days, the 15 worst days.
well, we're putting you in for that job at the Council of Economic Advisors.
That's awesome.
That is nice.
This is,
410's going back up, are we doing market time? Let me show you the probability of that one.
well, what they'll say is, yeah, the market time, just make sure you avoid the 20 worst days.
Yeah, right.
I'm not
Just do that. That's all you gotta do.
Just on 15.
It's right. 20 days out of 15 years.
If you take it to the left, I'm to the right.
Oh, no probability, no matter how big your.
John's looking at his church.
Trying to do it on this anymore.
Well, ESG report we have, is this really more?
That's something and that's going to the city commission finance subcommittee on the 31st. And, you read there were multiple attachments, and, I apologize for that, but that was all the backup materials that Brendan had helped us put together from the various managers. And then I also included the agenda item that, as it's going to go to the finance committee, and there's an explanation of sort of the process we went through to get here. The intent is just to show them that the managers are already doing fairly significant amount of ESG analysis, and there's no need for the commission to try to overlay that.
Show those 6 people that they just added at Brown, right?
So, and we'll see. Who knows how it's going to play out, but they requested this, and we put it together for them, and hopefully it will convince them that they don't need to continue worrying about their own private ESG mandates or anything like that.
Again, the 31st, I don't even know if they will claim to be citizen-centric. They've not been open, so I would think.
It's a public meeting, it'll be in the auditorium, and,
Okay.
you're certainly welcome to come and speak, and
The date, could you just send me just a quick link, and I'll look, I think the 31st I'm in town, and I would be curious to show up and speak my mind.
So to go to the group too, just the news item last week, Governor DeSantis had indicated that he was going to put in place a rule for the state funds that he directly oversees that essentially is going to ban the consideration of ESG. And the follow-up is the expectation is that is then going to get pushed, or he's going to attempt to push through the legislature next year to move a similar type of a ban to apply to local law plans or local plans. Now, again, being a general employee plan, I don't think they really have the carrot to truly put any restriction or prevent the restriction, for you. Certainly, it really applies more to police and fire if they were to proceed, but it's just an interesting conversation that while the city commission is looking at putting something in place, the governor is looking at actively preventing you from putting something like that in place.
City attorney's told him it's breach of fiduciary duty also. But
Yeah, I know, well, that is current,
some of our committees, that doesn't matter.
That's why you have to be attorneys.
Okay, well then, if there's no other items, I accept the motion to conclude the meeting. We have a motion, we have a second. We have a second. We are, meeting is concluded. Again, thank you, everybody.